good morning, or good afternoon, High 10 partners. We have a beautiful lunch in here, and we are so excited to have Exchange Resources in the house. And I am going to introduce from WFG Title, and she will do the formal introductions. Yolanda, take it away.
Thank you. Thank you. Hello, High 10 George Realty. And hello, all of you. Thank you so much for coming, taking time from your very busy schedule to hear this very important topic. So, like Michelle said, my name is Yolanda Martinez Arenas, WFG National Title Company. I do not work for the Exchange Resource Company, but I've had the pleasure of doing business with them. So I'm real excited. I heard their presentation. It's awesome. And it's very informative. As a title rep, when I'm out in the field, I get asked 1031 questions. I'm like, oh, I don't know 1031. I'm just a title rep. So when I heard Marcus and Adrina speak, I said, oh my gosh, I'm all about knowledge, and knowledge is power and education. I said, you have to come over and speak to High 10 George Realty. So I was so excited to bring them aboard here. So I've known Marcus for a very long time. And I've had the pleasure, like I said, of meeting Adrina and hearing her presentation a couple of months ago. What I love about these two is not only are they experts in their field of 1031 exchange, but they have a real estate background. And that is so important. That is so important. Adrina, escrow, she knows it. And Marcus is why I had to work extra hard. He was in title before. So they have the full knowledge and understanding of a real estate transaction and what this is all about. And the more you know about this industry, the better you can serve your customers. But now they are the experts about 1031 exchange. So without further ado, I am going to turn it over. But before I turn it over, we have a special guest in the house today. Oh my gosh, we are lucky and blessed. Alba Moy from Moy Escrow is in the house. Woo! It's always good to, Alba, we love you. Okay, so without further ado, I'm going to turn it over to Marcus. I think he's got an introduction or two, and we're going to get into this wonderful presentation. Thank you.
Thank you so much, Yoli. It's so good to be here. I want to thank you. I will also want to introduce, we have a special guest on our own right, and it is our Vice President CEO, Michael Spring, who is the founder of this company, of our company. And so I come with Adrina. I'm here in my old stomping grounds. This is now Adrina's new stomping grounds for the 1031 exchange. And I can't think of a better person to introduce to you with regard, as Yolanda touched on lightly. She has an escrow background. I have a title background. We love what we do. And I think it's because by talking about the 1031 exchange, we get to take a break from all of this talk about commission structures, right? And we also leave people with a new horizon to go for in terms of real estate. Sadly, we hone our skills as real estate professionals based on principles of home ownership, when in reality, there are two types of ownership. There's home ownership and there's investment ownership, and they vary greatly from one another. So my objective here today is to show you the very important role that you play in the 1031 exchange process, as well as opening up new horizons to meet some of the most loyal clients that you can meet in the area of real estate. There's no more loyal a client than a client that you help defer their capital gains. So without further ado, let me first start with a disclaimer. I am not a tax professionalist. Adrina is not a tax professionalist. Neither is Michael. We are not tax advisors. We are processors of a tax situation. We are also not lawyers. We're not legal professionals. You are going to be seeing some formulas. You are going to be hearing some concepts that have to do with both those professionals. Now, I'm sure that if you were a licensed person, you wouldn't want that to conflict in interest when you're doing real estate. So we're going to present this information for informational purposes only, all right? Now, who are we? We are one of the largest independent qualified intermediaries in the nation. We've done over 60,000 exchanges. What sets us apart is, like I said before, we're independent. We're not related to an escrow company. We're not related to a title company. We're not related to a real estate company. We're independent. And that seems to fare well with our clients, that keep them coming back. The other thing too is what we do differently than others, other qualified intermediaries, is that we do not commingle funds. Monies come into us and they are put in a segregated account for the taxpayer so that we do not commingle funds. Another thing too is we have we just increased our bond, our protection, our E&O protections, $10 million. That's, and we haven't had to use it, but we like having that security, right? And lastly, what I will say, we are not regulated by any entity, but we are rigorously audited. And one small discrepancy can bring down our 27 years of experience and all our future exchanges. So, little story time. This January, I took a late vacation and went to Puerto Vallarta for my Christmas holidays, after the Christmas holidays. And while I was there, there was a ton of American folks. And on the Sunday before I returned home, I was having brunch, and this American couple, I think they were from Victorville, we were talking, and they said, Marcus, what is it that you do? And I said, I work for 1031 exchange, for a qualified intermediary doing 1031 exchanges. Folks, they both turn 3 shades of pale. And they drop their forks, and the gentleman turns to me and says, where were you 5 months ago? Oh, what? They paid through the nose in terms of capital gains when they sold their investment property. And I said, well, we didn't know you. And what about your realtor? And they both said, his name is Mud. His name is Mud. Sadly, as professionals and real estate professionals, in some instances, investment owners themselves leave a ton of money on the table to evaporate because they do not know about this 104-year-old tax allowance. So what are we going to be talking about today? I'm going to talk to you first about what's important to investment owners so that you know what to say to an investment owner and what not to say to an investment owner. We're going to talk the 1031 exchange, the deferred exchange, and that's where Adrina is going to come in, and we're going to look at the process, the rules, the details, and the types of exchanges. And then we're going to give you some tools. Along the way, we're going to give you some tools and tips that you can use so that you can go after that business. We're going to have some question and answer. And along the way, as I said at the beginning, we have these notes ready for you in a PDF form. So if you send Adrina an email, she'll send them to you. But there are going to be occasions where both Adrina and I are going to give you some realtor winks, some information that you need to pay attention to and write down so that you know how to go ahead and work with investment owners. All right. So, as I was saying in the beginning, there's a difference between a homeowner and an investment owner, and they vary differently. They have different sets of motivations, different objectives, different pain points. I'll give you an example. When you're talking about homeowners, there's talk about motivated sellers and motivated buyers, right? But with investment owners, there's only one type of motivated person. That's a motivated investor, right? Buyer's remorse is a sensitivity that a realtor will discuss with a homeowner, whereas investment owners experience selling and buying regret. I should have never sold my first property, and boy, how I wish I would have bought more investment property 5 or 10 years ago. And lastly, the objective of a homeowner is to build a nest egg, while an investment owner's objective is to build wealth. So you can see different set of objectives, motivations, and sensitivities. So today, what I want you to do is put on the investor's hat and know that we're going to be thinking about things a lot differently than we normally do with homeowners. All right. What motivates investment owner? Well, first of all, it's monthly income, right? It's income that they're getting. We're talking about cash flow, and later I'm going to discuss rate of return, but that they're making money. Second thing that is important is appreciation. They buy something knowing that what? It's going to increase in value. Now, we have had ebbs and flows here in California. We had that crash, but what happens after? It goes up and it surpasses the growth, right? We grow, it goes up in value, right? It goes up in value. So they know that the investment is going to be worth something more in the future, right? And then we have tax deductions. They have tax deductions and depreciation, okay? Very important that we understand depreciation because it's something that's taxed when they sell the property. So depreciation is that allowance that an investment owner gets based on their purchase price. They can draw that allowance every year for the useful life period of that property. What they do is they take the purchase price and they subtract the land value so that it's just the improvement value, and they divide it by the useful life period of the property. If it's a residential property, units 1 to 4, they get 27.5 years. If it's a commercial property, they get 39 years. And when they do that, they figure out their the annual depreciation expense or that they can make. This one over here, property was bought 500. They are able to deduct 14,545 annually for 27.5 years. That's for wear and tear, for upkeep of the property. But what happens when that 27.5 years is up? They no longer have it to offset their income, and they cannot, so their depreciation is going to factor in, right? Now, let's look at when we're talking to a 1031 exchange person, they're going to have one of those objectives, like I said, cash flow, income, appreciation, or tax deductions. Sometimes it's a combination of all three. Sometimes it's just one thing that they're after. But I want to point this out and tell a story so that you can understand it in real life, all right? So taking into consideration, I want you to imagine that we have the Rossi rental and we have the Rosales rental. They were purchased at the same time for investment. Purchased at the same time, in fact, in the same track. As a matter of fact, they're the same model. They're just a block away from each other. They have the same square footage. They have the same lot size. The only difference between these two properties is that the Rossis have more equity, whereas the Rosaleses have taken out money and possibly invested somewhere else, right? Or they're using that money, right? So a few questions for you. Which is the property with the greatest cash flow? Cash flow. Cash flow. The Rossis, because they have less expenses. I didn't say that. They just have less equity. I didn't say that. I mean, that could be the case. That could be the case. That could be the case. I didn't say that was, they possibly did that, right? But just on the face, who has the greatest income, the most income, right? The Rossis, they do. Is that a bad thing? No, not if the investment owner is going to retire, because they're going to count on a pension, but then the pension's not going to cover their expenses at Costco when they go and take the grandkids or the Disneyland trips, right? So it's nice to have the check. So as a person who's retiring, they're possibly going to want to do away with the debt. So it's not a bad thing. Otherwise, you got to keep in mind that the more you make, the more the government takes. So it's just a question of where the investment owner is in their financial life. Which is a property with the highest rate of return. Now, let me preface that with saying, If you were to take money from your bank account and you were to invest in a CD, how would you figure out the rate of return? By the interest that they're offering you, correct? With investment property, you use the equity to figure it out. You use the equity. So let me show you how that's done. The way that you figure out the rate of return is by taking the gross annual and subtracting the annual expenses. So that would be the monthly mortgage times 12, plus insurance, property taxes, maintenance, utilities, and other expenses. When you subtract the one from the other, you get the annual net income, okay? You get the annual net income. Then what you're going to do is you need to get the estimated net equity of the property, because you're going to divide. And when anybody needs to make this calculation, they're going to, guess what? They're going to need a CMA. So you offer them to do a CMA for them. All right. So when you divide the annual net income by the estimated net equity, you get the rate of return. Okay. So now let me ask you, which property has the greater rate of return? Before I say that, you answer that, let me just ask you this question. You know what the word surreptitiously means, right? Just out of nowhere, right? Out of nowhere. Because they have more equity. Could they surreptitiously raise the rent? Could these people, because they have less equity, surreptitiously raise the rent? No, they can't. Why? Because rent is not, there's rent control, but it's controlled by the market, right? The market determines what it is, right? You can't all of a sudden say, hey, I need to make more income and then just surreptitiously raise the rent. So by that factor alone, you should probably have an idea of who has the higher rate of return. But any guesses? Okay, let's do the math. Let's do the math. I want you to pull out your calculators and I want you to pull out a pen. Let's just, for the sake of argument, agree that the net annual income is $17,000. I want you to take 17,000 and divide it by 450,000, meaning a lot of equity. 450,000. 17 divided by 450,000. What do you get? 3.7, 3.8, almost 4%. Now what I want you to do is take the 17,000 and divide it by 50,000. 17,000 divided by 50,000. 34%. 34%. So 30% more rate of return. So who's the winner? The Rosales is. So what that tells us is that, and especially capital gains, equity really doesn't have anything to do with it. But your equity just sitting around is not doing anything for you. So the higher the equity, the lower the rate of return. And that matters to an investment owner. The higher the equity, the lower the rate of return. All right? Now, which is a property that's going to appreciate the most? It's good. It's a trick question. Very smart. That's a trick question. They're both going to appreciate at the same time. Now, which is the property with the best tax deductions? Best tax deductions. Rosales. So the people who have leveraged their money the best are the Rosaleses. Here's another note that I want you to take. An investment owner is never married to their interest rate. An investment owner is not married to their interest rate. I know that for a fact. When Yoli and I were coming into the business, what were the interest rates? Right? Ginormous. Investment owners are not married to their interest rate. That's a principle that has to do with home ownership, because last I checked, you're able to write off your interest. All right? It offsets your income. All right? So here are the clearest first place winners in terms of how they leverage their money. And now you have a clue, a little inkling of what's important and why they need to do the 1031 exchange. All right? So now let's take the Rosales are the winners. Rosales are the winners. Okay. Gains are figured out. It's a difference in value from what you purchased to what you're now selling for. Has nothing to do with equity, folks. It has to do with value. Has to do with value. So you get the sales price, the current sales price, and you subtract the adjusted basis, which is the original purchase price plus capital improvements minus depreciation. Let me ask you this. How many of you have ever been asked, I need to figure out my capital gain? You get that all the time, don't you? I know if we're entitled, they ask us to help them figure out their capital gains. You should never do that. Do not go there. Do not step into those legal waters. Do not, because you are not privy to these two figures, the capital improvements and the depreciation, in order to do that. I know that makes you feel bad, especially when you're working with a client that you so want to bind yourself to. Here's a little tip. Here's a little world to win. The next time that somebody asks you that they need to figure out their capital gains, you say, look, I cannot do that for you, but I'm going to set you on your way. I'm going to run a CMA of your property. You're going to take that net equity value, or the value of your home, and you're going to take it to your CPA so that you'll have exact figures. That way you're not feeling bad that you're pointing them in another direction, but you're pointing them in the right direction. And the theme of this class is going to be learn your lane. Do not seek to be the horse's mouth for everything, because you wind up being the horses behind. Okay? So that's how capital gains is calculated. All right. So we're going to take a look if this rental owner, let's say the Rosaleses were going to sell their property, right? If the property is valued at 1.5 million, what would be the capital gains tax? What would they have to pay? We start off of the top. All that depreciation that they might have taken or not have taken, the government wants 25% of the back. So they're going to calculate the depreciation for you, and they're going to ask for 25%. Not ask, they're going to demand 25%. Okay? Then we have the IRS, which is up to 20%. And then we have California 13.3. Ding, ding, ding. Yeah. We're the winners. We are the winners because we're kind of broke. But anyhow, enough on that. And then we have the Medicare surtax, the Healthcare Reform Act. Some people call it Obamacare. Now, well, that leaves us with just 60% for reinvestment. So what does that mean? Approximately $400,000, almost 40% of your gain cannot be reinvested. It has to go to Uncle Sam. All right, Uncle Sam and the California Bear. So what's the solution? The 1031 exchange. I'm going to hand this over to, but I'm going to give you a little history before. Yeah. I'm going to hand this over to Adrina, but it's the 1031 exchange. Back in 1921, we were kind of in the same situation that we were. We were just coming off of the vestiges of the 1918 pandemic, and we had a farming crisis. If you know anything about agrarianism, there's such a thing as crop swapping, where a farmer will cultivate a certain crop for a season and then depleting the nutrients in the soil for that particular crop, leaving it fertile for another crop. So they would either have to cultivate a new crop or transfer to another property or another farmland where they could cultivate their crop effectively. When they were doing that, they were realizing a tremendous capital gains. So they got together with their congressman, and in 1921, into the fiscal code was section 1031, which allows an investment owner to defer, not avoid, not cancel, not forget, but defer their capital gains when they exchange their investment property for another property going to be for investment or business purposes. And now Adrina is going to go over.
Do this slide.
I'll do the slides.
Hi, everyone. Thank you again for having us. Isn't it great? Marcus. Okay, so I just wanted to go over the 1031 exchange, the requirements that we always go over every time we talk to a client. We want to make sure they meet these 4 requirements. Number 1, we ask them, have you had your current property that you're going to be selling for at least the last 2 years? And have you had it declared on your taxes as an investment property? Some people, you know, have income properties for whatever reason, they didn't declare it on their income taxes. So we have to make sure that they've declared it. Also, the intent is to purchase a replacement property that you're going to also rent out or for business use. So it's really important that first requirement is met, okay? Second requirement is, as far as the holding period is 2 years, which I talked about. The second requirement we have is like kind of property for investors to be able to do a 1031 exchange. They have to sell and buy like kind property. What does that mean? It's not the structure. What it is the intent for the use. We have people who have condos for rental. They can sell that and buy a single family home for investment purposes. Or sometimes we have investors, they want to live in one unit and rent out the rest of the units. That's okay too. We just take away the primary residence portion and they can do an exchange on the rest. So it's really important what the intent is, not the structure type. You can even sell multi-family dwellings and buy vacant land. For investment purposes, you can hold it. So that's the second requirement.
Let me ask you this, why vacant land? You heard vacant land, right? Why? Because like Adrina said, for investment purposes. I've met many an investor that says, boy, how I regret not having bought that little patch of land in, where was it? That place called Hermosa Beach, Newport Beach, and as recent as Fontana and Pomona.
Yes, very good. And then the third requirement we go over with them is, this is really important, the tax ID number of the person or the entity that sells must be the same tax ID number that purchases. So we can't have one person sell under their own name and then buy the replacement property under somebody else's name. They can partner up with someone in the replacement property purchase as long as they meet their values. So that brings us to buy equal or greater in value. They have to take, like Marcus went into very detailed explanation on his presentation, they have to reinvest all the proceeds that they get out of the sale. Okay, so those are the 4 main things. Sorry if I'm going a little bit off the slides.
And here are the properties that do not qualify.
Yeah, so the properties that don't qualify at all for 1031, I get this call a lot. Primary residences do not qualify for a 1031 exchange. For a primary residence, as you know, Yolanda mentioned, I come from the escrow background. So for a primary residence, if the person has lived there 2 out of the last 5 years, as an individual, they get to write off $250,000. That's the Section 121 exclusion. As a married couple, they get to write off $500,000. Yes, so, but if they have lived in the property, but they're renting it before they sell it, then they can combine the 2 and they can have a lot of benefits for tax write-offs. Other type of properties that don't qualify are people who are doing flips, developers who are developing properties and holding them in, you know, in inventory for sale. Those do not qualify for a 1031 exchange. Primary residence, we went over. Manufacturers, home don't qualify for a 1031. Also, personal property doesn't qualify. So let's say you have an investor, they want to buy a real estate building and a real estate office within the building, right? So the structure, the land, the walls, or the structure itself qualifies for the 1031, but the copier, the machine, the equipment, anything that's personal property does not qualify for the 1031
And
exchange.
that's as of 2017.
Yes, that's as of 2017. So stocks and REITs do not qualify for a 1031 exchange. The only REIT that qualifies is called a 721 up REIT. And that is something that have you heard of DSTs? Delaware Statutory Trust?
We'll talk about those in just a bit.
Yeah, we'll talk about those in a little bit, and then we can talk a little bit about the REITs from there moving forward.
Okay.
So going back to the manufactured homes.
Okay, yeah, go back.
Grounded and they're bolted to the floor, do they qualify for a 1031? To the ground?
Likewise, with a lot of mobile homes, you may not necessarily own the land. It could be leased, and IRS requires at least 30 years.
30 years plus leasehold, yes.
Yeah, it's really just the parcel that you have title to.
Right.
So
And if you question whether it's a manufactured home that qualifies as real property, you can always call Yolanda and her team. They're great. They can find out if it has a 433C form, I believe, 433A or C form, and that establishes that as a real property because it's affixed to the permanent foundation.
Yes, that is very true. Some people are looking into the Palm Springs area, Joshua Tree area, have ideas to buy land, buy the manufactured homes. I had a couple of calls like that lately, and affix them to the ground. So they were looking if that's a good 1031 option for them.
But what about vacation homes, Adrina?
I think that's your bid right there. Go ahead, Marcus.
Vacation homes, they do qualify, but only under certain circumstances. And there's a criteria. The property has been owned and held how many years? 2 years, right? Held, well, by held, we're saying it's declared on their taxes, right? And then the property was rented at fair market value for 14 days out of each of those years, okay? 14 days, your Airbnb properties, right? And then the personal use of the property, including when family and friends use it and do not pay fair market rent, cannot exceed those 14 days. I'm sorry, cannot exceed the 14 days or 10% of the total rented time, all right? So there can be done. Again, what we're pointing out is not the rules that we enforce, but the rules that the CPA follows on behalf of their client, all right?
That's why we always defer all the clients to first seek the advice of their tax professional to see if the 1031 is beneficial to them, and then we'll be more than happy to help them out. But we always have that conversation with the clients. So the investors that we come across, there is the very complicated, sophisticated transactions, and there are also many investors that own smaller investment properties, duplexes, condos, fourplexes. They are the everyday people that you run into. They are not very, some of them are not very savvy in investments. They really need the realtor's help to find out how they can defer the taxes, if the 1031 is a good strategy for them. It is a magnificent wealth building tool, the 1031, because with the 1031 exchange, they can keep exchanging their properties until they're no longer here. And the heirs, let's say, hopefully it's in a trust, the heirs that receive these properties upon the death of the investor receive it at a step up in basis based on the value of the property on the day the investor passed away. So that is a very good wealth building tool. Going to something that Marcus was presenting, and I was thinking about it, you have different types of clientele. You have the clientele who are investing in properties in the United States. They're not really looking for that monthly income. What they're looking for is the appreciation and the value and the growth. And there are some that are looking for the monthly and some are not. Some are looking to just leave something behind for their children or grandchildren in the future. So it's really important to find out what the long-term goals of your client is And then you can strategize how you want to pitch the 1031 exchange to them for all the tax benefits and the depreciation and appreciation, everything that comes in a nice package. So there's me winking, saying, remember that?
She's winking because, you know, you nor we, as professionals that we are, nor Yolanda, can ever advise anybody on how to vest their home. We cannot do that. But we can speak about the many advantages there are to putting your property into a trust. And I like to say this right now because it's so important. It's so important. How many of you own property? How many of you have it in a trust? Okay, good. If you haven't, you don't have a Christmas gift, but that trust this year. You're not taking a vacation. You're going to get your property into trust. It is so important because if the pandemic didn't teach you anything, tomorrow's not guaranteed. It's a sore subject, but it's even sorer when you're not prepared. And I bring this up because of this. I was having a conversation just recently with a realtor who came to me and said, you know, I'm working with this gentleman. He has a lot of property. He wants to exchange some of it. And as we were talking, he sounded like a difficult man and a stubborn man that I knew who, before he passed, I managed to get him to put his property into a trust. He just rang familiar. And I said, Debbie, let me ask you something. Does this gentleman have his property into any of his properties into trust? She said, no. I said, you know what? Stop what you're doing and tell the gentleman, I would love to help you, but your properties are not secure if they're not in a trust. And I'll tell you why you want to tell him that, Debbie, because let's say you do a 1031 exchange with him and it's a successful. And 2 months after it closes, he cacks. That's the term that we use in my family. He dies, right? He cacks. They're going to have to put that property into probate. What's going to happen then? You're going to have some heirs and a lawyer, probably a probate lawyer. What did you have him do with his money? And you're going to get yourself involved in court. So you can never advise on vesting, but you could always advise, and you could use that to help these people make the right choice in protecting their property in a trust.
Okay, we talked about all that. I think we want to also leave some time probably for
some questions.
Yeah. Let's see what else. I think we went. So when you have a 1031 exchange, there's the sales price. Marcus has 1.5 in this example. The only thing that you can take off right from the top is the non-recurring closing costs. And we have our escrow star here, and the non-recurring closing costs are commission, escrow fee, title fee, transfer taxes, recording fees, absolutely. And any contractual agreement that was made between the seller and the buyer during the course of the escrow. That doesn't mean getting the property ready ahead of time. This is the buyer requesting a credit or some type of repairs, and has to be documented. And so it has to appear on the closing statement at the end.
Michael, does termite home warranty, is that also as a...
It's a non-recurring closing cost. It's a one-time.
I have a question for Michael. I got this one today. Would the city report that they have to do for the sale of the property, would that be?
The 9A?
The 9A?
Yeah, it's a one-time cost.
It's non-recurring, yes.
Yes, non-recurring.
Yeah, non-recurring.
Yes.
Perfect.
And so that leaves, let's say in this example, the non-recurring closing costs were 100,000. The placement value would be 1.4 million, right?
Yeah, I have a question. You mentioned about a flip property is not qualified.
Because it wasn't held for investment purposes. It's inventory. Yeah, Michael. Yeah.
And don't you have to own it for 2 years though?
2 years.
Yes,
yeah,
and if they're flipping, they probably didn't own it. I mean, during COVID, you know, I don't know, but yeah.
It's a holding period.
Holding period.
We don't make them up. We just repeat them.
Yes.
How about if I sell in California, can I go to Nevada?
Yes, you can go in any state. You can go in any state.
My heirs tell it that what you said about all the taxes, since they don't have a state tax in Nevada. I say I transfer to Nevada.
Okay.
And I hold like 5-6 years over there.
There is such a law that was enacted. It was called back in 2014. California wanted to disallow exchanges to other states, but because it's a federal program, the United States quashed it down. So instead, what they created was the clawback law. You can exchange out of California, you know, the claw on the flag. But each year that you prepare your taxes, you declare your taxes, you're going to have to report on a 3840 form, I believe. It's a 3840 form. California wants you to report to them just to make sure that you're continuing to hold it as investment property. So then in the event that you would sell it, they can come after you for the cumulative taxes that you've deferred. But in your instance, you're going to Nevada, you're leaving it in a trust. When you CAC, your heirs are going to be able to receive it at the step up in basis. That's what current law allows. But I will preface it with this. In my lifetime, taxes have changed. In my lifetime, we've created the 3.8 surtax. In my lifetime, we've created the 25% depreciation recapture rate. That's what current law allows. Who knows what? And you know, laws change every administration. You're right. So just so that you know that.
It's really important. If you did not fill out the sign-in sheet, please do so, because one of the things that we're really good at doing is always updating our clients. You are our clients as well, with updated information about what is happening in the industry.
Right.
So when you're in the database, you have the benefit of getting all this information, our monthly newsletters, anything that's going on, and that will also help you, stay updated. Yes.
Oh, right.
I think Yolanda had a
Go,
question.
yeah.
So, scenario, like you said, that say a family sells their residential rental property for 1.5 million.
Mhm.
They're doing the 1031 exchange. Can they buy two properties?
Yes.
Okay, so can you want to touch on that?
Yes,
We're going to
absolutely.
touch on that. We're going to touch on the
Yes.
timeline now.
Yes.
The exchange process.
Okay.
When does it begin?
Okay. So what I really suggest is, as soon as you have a client who's an investor, who's interested in selling their property, these are the questions you want to ask. Are you selling anything? Are you looking to buy any investment property? Do you need to move your business, right? Those are the main three topics that you can get into a conversation with an investor on. So as soon as they're interested in selling their investment property, please contact me, okay? And I'll be happy to put you, on a conference call with your client. If you like to be there, if you don't, I can talk to them myself as well, kind of go over the requirements. We want to get involved from the beginning to kind of talk to our administrators. We have amazing administrators in the office. I have used Exchange Resources as an escrow officer for over 26 years. The staff is really amazing. We also have attorneys on staff. Our founder, the owner of our company, is actually an attorney as well. So we want to get involved from the beginning. Then once you're listing the property on the MLS, if it's going on the MLS, if not on commercial property, LoopNet, wherever it's going, make sure that you let the potential buyer know the seller intends to do a 1031 exchange. That's really important, okay? There are also forms. If you use CAR or ZIP forms, there are forms that you can use to, make contingencies or talk about the 1031. If not, an addendum would do. So as a buyer, if you're doing a reverse exchange, they're buying first. You always want to put that in, make sure that it's included in your package. It's really important that these things get disclosed from the beginning. Okay, so.
Because it gets everybody to know who we are, because we're going to be an appendage to escrow. And we need to talk to that client. There's been times, folks, that we close an escrow, and they say, we need to do a 1031 exchange. Guess what? Too late.
Too late.
Too late, because it's what's considered constructive receipt by the IRS. Yes, it's in escrow, but it's directable by you, so it can be taxed.
And also it ensures that your escrow officer knows there's a 1031 exchange, because they are the most important person that brings everybody together. They need to know there's a 1031 exchange.
It begins with escrow. It begins with escrow. When you go into escrow for the relinquished property, we need to be assigned so we can get paperwork signed, so that the exchanger can fill out that affidavit that says it's their intent to buy another replacement property, right? Yes, you had a question.
Yeah.
I just like to know that. We need to be aware of about 1031. Otherwise, it's just basically the same.
We're gonna
Yes.
show you that. We're gonna show you the.
The presentation is on a basic 1031, but go ahead, Marcus. Do you want to move forward and then we will leave room for
Yeah,
Q&A?
you have another question. We're going to answer these questions. So if I deem that we're going to answer these questions, ask it now. But I'll let you know if we're going to be covering it in the slide. Yes, your question. It has to begin when it goes. Well, you already want to get in touch with us because they're going to be talking.
You have to have an addendum
You have to have an
prepared
addendum added
that
to it.
says
You have to add
the
an
seller
addendum.
intends to do the
But the
1031 exchange.
exchange process comes to us when you go into escrow, when you open escrow.
We're saying get us involved as soon
Get
as
us
you know.
involved because we're answering questions for the client with their CPA. So typically they'll come to Adrena or I and they have a question, the client, we say, and they have a particular, we do not calculate, we do not give facts, figures, or calculations. We have them go and talk with their CPA. Later, they can come back and talk with one of our administrators or with Michael or somebody, and we will design the exchange to fit their tax deferral needs. That's basically how we do it. All right, let's talk about the timeline because this is very, very important.
So let's say your investor wants to do a 1031 exchange. We have signed all the paperwork, everything has been done. And the proceeds all have to come to the QI at the end of the escrow. That is a requirement. The qualified intermediary. Yes.
The accommodator.
Yeah, the accommodator, yeah. The timeline is the day after the escrow closes, the next day, starts a period of 45 days that the investor has to identify up to 3 properties that they're interested in. We also have another rule, which is a 200% rule, but we'll stick with the 3 property rule right now because if they're buying in California, the values are high. So 45 days to identify up to 3 properties, and they must purchase at least one of them, if not all 3 of them, right? And they have 180 days to close on the replacement property.
So let me rephrase that for you. You have 180 calendar days total. 180 calendar days total. Weekends and holidays count. The first 45 of those 180 days are the identification period. So you have those 45 days to identify 1 to 3 properties that you're going to exchange for. Now, Yoli's question, you're selling 1, you're going to identify 2 that you want to purchase at value by closing. And we do those all the time. We do those all the time. So yes, you can do 2 or 3, whatever.
Okay. Do you want to skip forward? Because any changes that you want to go over? Yes. Yes.
They say in 115 days
Mm-hmm.
for the period, or 120, whatever. Escrow fall.
Yes. So unfortunately, if they have identified 3 properties with us, we have the identification before day 45, which is what we want. They need to do that. But the escrow falls through anytime day 110 or whatever it is. We have to hold all of the proceeds. It is a failed exchange, okay, if they don't buy one of those 3 properties. Now, sometimes escrow falls through, but then they go back to the table and they renegotiate again, and it comes back up and it closes. We've seen that happen.
Mm-hmm.
But if it absolutely falls through and they didn't buy one of those properties, we have to hold the funds until day 181, because that's when the live active exchange period is over. And then we will give the proceeds back to them and they have to deal with the capital gains. And it's a failed exchange, unfortunately.
So let me give you some scenarios, okay? You have those first 45 days. You can change and permutate those 3 properties that you want to identify as many times as you need to up until midnight of the 45th day. After that, it becomes irrevocable. You cannot change that list. So let's say you've gotten it. Doesn't mean that you can't be in escrow for the replacement property while you're in escrow for the relinquished property. But you have those, everything starts happening after you close, right? So let's say you're in day 38 and you get into escrow. Day 45 comes and goes, and now you get to day 39 and you fall out of escrow. We all get on our dimple knees and pray that one of those other 2 properties that you've identified are still available out of that irrevocable list. If not, it is a failed exchange. And we cannot return any proceeds until the 181st day. There are times where we go the full 45 days and the person has not been able to identify anything. It's a failed exchange, but that list, they haven't put anything on that list. They haven't provided anything on the list. They have revoked the exchange. And if it's before those 45 days, we can return the proceeds that come because they're not going to go forward with an exchange after all.
On day 46.
On day 46. It's been my experience, and I'm sure it's been Adrina's experience. Most of the exchanges that we have, they close on one day and 3 days later they close on the replacement, right? Yeah. It's typically that way. They've started their shopping early. Here's another realtor wink for you guys. Here's another realtor wink. Do not assume that you're going to be the realtor for both transactions. When somebody comes and they says, and you figure out that they have to do a 1031, that they're going to do a 1031 exchange, have you started your shopping for the replacement property? Can I help you find the replacement property? Can we sign a broker buyer agreement? That's the way that you want to do it. Do not assume otherwise. I've had some pretty technical experiences, some delicate experiences where the realtor thought, well, they didn't use me, and they wound up badgering the person. You know, it doesn't look good on you, right?
Okay.
Adrina, before on those 3 properties,
yes,
the 45th day or by the 45th day, if one of those 3 that you identified and the seller decides not to, and you can replace that with another one as long as
up to the 45th day, you can change the identification period as much as you want. Yeah. You know, one of our senior administrators told me was, really, they don't need to turn in that form until day 40. Because by day 40, they already kind of have an idea. Do I have a chance of buying any of these? Hopefully, they're already in escrow.
Better.
You're waiting to see what else comes on the
yes.
market.
Right. Yes.
Right.
Yes.
Totally makes sense.
You're right.
I
Right.
didn't think about that.
Yeah.
Yeah. But we will be, the administrators will be sending emails. They have they've calendared this, and like Michael says, we're going to be hounding people. Where's your form? Turn it in. We don't want them to miss that deadline.
Exactly.
But
okay, that makes
right. Yes.
I'm kind of lost. Let's say you identify the property within 45 days, and all of them later not available or sold or whatever.
Right.
Or do you have extension to?
No. No. Once you identify those properties, okay, and there's a form they complete. They give it to us. The properties are identified. If they don't buy any of those properties, it's a failed exchange. They have to pay the capital gains.
You can, that's what we typically see. He asked, is it okay to go into escrow for the replacement? Yes, you can. Yes, you can. Before you could be having simultaneous escrows and just timing them out contingency wise, so that the replacement property close after the relinquished property.
Can you identify more than 3 before the 45th day? I mean, because sometimes it's hard, right?
Yes, but if you plan to identify more than 3, what happens, Michael?
So the IRS lets the taxpayer choose either rule. You can't use both, either the property or the 200%. So the way the 200% rule works, let's just say, you're selling for 500,000, double that. You're at $1 million, so now that's 200%. You can identify 4 properties or more. You have to list the max purchase price for each one of those properties and add the total at the bottom and exceed $1 million or 200% of what you sold. So that rule is less used. A lot of folks will use it if they're selling in California, buying items, et cetera. Most people go with the free property rule because both that value does not matter on the free property rule. Identify free property for billions of dollars.
Thank you.
Right. So it is kind of tricky, but it's, it's a designated amount of time. It's only 180 days, and the first of the 45 days are the identification period.
There is a little cheat sheet here that we have put together. It kind of goes over the basic requirements. Please take one. It is enough information for you to be able to have a conversation about the 1031 exchange, and anything above and beyond that, that's what I'm here for. I am the rep for your territory. Of course, you're always, we like to talk to Marcus too, but we're always here to answer your questions. And as I said, get on even a call with your client. So take one of these. It's really good information.
I do want to just point out one last thing with the replacement property, with replacement price, because this has a hard time. People have a hard time conceiving of this. Let's say in this property that's selling for 1.5 million, they have a loan on it for $500,000. Let me ask you this question. Just because you have a loan on a property, does that diminish its value? Remember, capital gains is not based on equity, it's based on value to value, okay? So in this particular instance, when we've adjusted the sales price to get us the minimum, they have to buy 1.4 or more. When they close escrow, they're going to pay off that $500,000, right? And we're only going to get $900,000 brought into the exchange. But before we close, we're going to need to replace that debt with either $500,000 or more in a loan or $500,000 cash. Because anything that does not get transferred over, folks, is considered boot. So there's sometimes that people go, well, I want to buy for less because I can use that money. Talk to your CPA, because after taxes, it may not be enough, and it may not be the figure that you wanted. And similarly, I need to pay off the loan. You talk to your CPA. But if that $500,000 were not to transfer over in debt at value, they would be charged that capital gains rate that we showed before on those $500,000. So all the value has got to be replaced. And if they want to take out some more money, if they're going to want to cash out, they're going to consider that boot too. Yes.
Sorry, I have missed the previous slide. You have mentioned the 1.5 million. Then the new purchase price become 1.4.
1.4.
Okay. Is it means because before we do the exchange, we need to buy equal or bigger, right? Than
Yes.
The selling price. So what you mean the new purchase price means, which can mean minus the
Non-recurring closing costs.
Right.
You would.
So it's new.
No, they've always allowed you to deduct non-recurring closing costs. So yes, they've always allowed you to deduct non-recurring closing costs. So here's where that would fit in. Let's say you sell at 1.5 million, but you can't find something. It's you have something 1.4485 or 435, but it's in the location you want. You would be able to do it because you have the minimum replacement price of now 1.4 or greater. Non-recurring closing costs. Yes, it can. Yes.
Yeah. And I have another question, but I think it's only a rumor, which is what I heard. If the seller is selling his home, but he hopes the daughter can become a primary residence in the future. I mean, after the rental. So that's what I heard, that the daughter maybe can put some money into the escrow or obtain some loan, then putting her title. But that's not, it's false, right?
No.
Well,
Go ahead.
Yeah. So let's say the person is selling for 1 million. They're going to, they are only on title by themselves. Okay, they're selling 1 million for me, right? The father selling for 1 million. Now they're gonna buy $2 million property. As long as they meet their value, they're investing their 1 million. Then the daughter can come in and join, with them on the title and take a loan out or whatever they're doing to bring in their 1 million into the transaction. However, this can get complicated because when they are going to, if the daughter is going to live there, right? This is an investment property. They have to pay fair market value rent to the investment portion of the property. So they have to talk to their CPA about how they're doing the percentages, how they're going to divide this up so that it doesn't jeopardize the integrity of the 1031 exchange that the seller went through to buy this property.
Okay.
Okay.
After 3 years, but after 3 years, it can become.
There is no timeline.
No.
The IRS doesn't have a timeline or a scenario.
La 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 la. This is what we do. This is what we do when we hear that. So, and to add to that, okay, the daughter could come on, but for her portion, she would come on as a tenant in common for her amount. Okay, and if it's an investment property that she's coming on, she couldn't. If it's an investment property, it would have to be a duplex so that she can make part of it her primary residence. It wouldn't work for her being in a single family residence and just having roommates as renters. That's not going to work, right? It's not going to work. It's going to be, they would buy a property that would facilitate her occupying one unit.
Michael is going like this. Let's see what Michael thinks.
Daughter says, well, I'm together for, we're gonna rent a bunch of crazy calls. Okay. That might be okay. And I say might be because it depends on how they're gonna report it with their CPA.
Right.
It really depends on her ownership in the property. Is it really a fit? Okay, it's really a fit in the bedroom, the exact size, and she only uses it 5 days a week. Maybe it'll work, but it's very, very tricky, very complicated.
Very
Yes.
tricky.
Trina and I had a late night call the other night with somebody who wanted to buy her brother out by like 30.
Mm-hmm.
And she said, well, the other 70% of my primary, but I rent out to got a long history. Wouldn't have to stay on your taxes.
Mm-hmm.
It less is a cool, but if not, if your CPA says, look, the California franchise tax board, you're not going to back you up and do it.
Yeah, don't do it if they're not going to back you up.
First question. So if the father buy a 2 million, the daughter join 1 million. So can it be a single family home or no?
Yes.
Yes, it can be a single.
It can be a single family room.
In this instances, we say, please talk to your
Talk to your
CPA and see when they go to report this as the replacement property, how they're going to file the taxes, how they're going to structure it, and if it's okay.
Yeah.
And if they say, okay, we document it and we put it in our notes and, we move forward from there.
But it gets very tricky when that if like I said, if it's just one property, and she has 50% ownership of it, and she's also using it as her primary residence, it gets very tricky because there's that. If she were to exchange and she would now declare the income on the tax, she has it as an investment property. It works. It's every day and twice on Sunday. But if it was just going to be a rental where she's going to participate, yes. But if she's going to occupy it as her primary residence, that's when it gets sketchy.
I saw one more question. Yes.
The one with the calculations? Yes. The 1.5 sale?
Yes.
Oh, the one before that?
I think the numbers, this one. Mhm.
That's a good question.
That's the second loan.
Good question. So if anybody wants to do a seller carry back, usually what stops them is as soon as you say if you exclude 500,000 and carry another 500,000, that's when
It is.
seller, part client. Unless, like you just said, unless they come in with full escrow on the property, they replace the face note value, 500,000. They come in and they'll replace that with cash. They'll send that to ERI to us. No tax. They're replacing it. They can carry that note. They can do whatever they want, but they have to replace it. If they don't replace it, they full value.
See, yeah.
The 500,000,
The
yes.
500,000, or take out new debt.
Or
They
take,
replace
or
it.
exclude that part from the exchange. It all depends on the values. Like if they're doing a $4 million sale and there's a $500,000 loan, and let's say there's some kind of a carryback, maybe it's worth it for them to just do the exchange, but exclude the $500,000 from the exchange.
Maybe everybody has their own breakoff point, but here's the thing that you got to consider. Are you talking about offering the buyer of the relinquished property a seller carryback? Is that what you're talking about? No. Ah, yeah.
So they need a promissory
They need
note.
a promissory note. Well, off of the equity, you probably wouldn't want to do it. If she has that liquid, she'd probably loan, and it'd be like a loan to her, a promissory note that is insured to the property. But otherwise, if you're doing a seller carryback, like Michael said, you're going to be taxed on any money that wasn't brought forth. And also you're creating another tax situation because it's an installment sale and you're getting income from that. So you're creating two taxes.
I have an actual write-up for the options. If you like to email me, I can send it to you. And it defines clearly what options are
options that
possible with a promissory note. Are there any other questions? I think we've taken enough time. Yes.
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 Want to purchase an investment property as LLC. So is that possible, or do you have to buy the investment property as trust first and then later?
So that's a great question. One of the requirements is that the tax ID number stays the same between the two transactions. So, so to the IRS, we're all more than just a name. We're a social security number. If the current property is held in a trust, most likely, you know, it's a revocable trust. They're filing taxes under their social security number, as an individual. So when they purchase the property, if they're buying a single member LLC, we rather not see too much vesting change. To be honest, it could create a red flag. But if they're buying it under a single member LLC, they still have to file under their social security number for the new property. So the income taxes still get filed under the social security number. So the IRS can correlate the transactions together that way. The only time that you cannot really change title, investing and all that is when you have a multi-member LLC and the partners, want to go their separate ways. So only one partner wants to buy. And there's different strategies. We can go over that if that happens. What are the options? Contact us and we'll be happy to talk to the client.
And it's the difference between what is known as an LLC as the taxpayer or a disregarded LLC for the purposes of protecting their liabilities in terms of vesting. Okay. There's a difference.
Thank you, everyone. Yeah, thank you.
Thank you.
Michelle, thank you for having us today, and Yoli.
And Adrena is a world of knowledge. She is here to serve you. You know, anytime you call me, I'll defer you over to her because
Michael.
Yeah.
Katrina,
Thank you.
Couple months ago, the audience, the realtors were asking us so many questions. It went beyond. And that's why it's so important to have this knowledge, and this can mean getting a couple more listings or a couple more sales. So you see how valuable it is, and this information.
Oh, you so have.
This will help you on
Yes,
that. I hope, everybody.
thank you very much. Did everybody sign this?
You all on
And I
Zoom.
can, oops, sorry. Thank you. Thanks.
Yoli,
Thank
this
you.
is Yoli.
I
This is
will,
Rebe-
you have my information, but if, would
Rebecca.
you like to have a copy of the
Yes.
presentation? Would you like for me to email it
I'll
to you?
call you later.
Yoli, I need one of those cheat sheets. Can you give it a Jacqueline for me?
oh, you
Very informative. We'll have them back again. There was obviously a lot of questions. For those of you who didn't get to eat, please grab a sandwich. I know some of you didn't get